Retail traders often experience a brutal stop-out. Price drops to hit a stop loss at support, only to immediately reverse into the intended direction. This occurs because traditional technical analysis treats support levels as static floors. In reality, these levels are dynamic zones where liquidity is either generated or exhausted. Price moves between concentrated pools of orders. These pools represent the liquidity required for large-scale participants to enter or exit the market. Large institutional desks operate with thousands of contracts. A simple market order at current prices would cause massive slippage, significantly worsening their average entry price. To fill these large positions, algorithms often drive price into areas where retail stop losses are concentrated. These stop losses provide the necessary volume to match institutional buy orders. A long stop loss order is executed as a market sell order. When thousands of these are triggered simultaneously, it creates a surge of sell-side liquidity. An algorithm can use this flood of sell orders to fill a massive buy position at a stable price level without driving the market higher prematurely. This engineered volatility allows institutional participants to acquire the necessary fuel for a move, while retail traders are forced out of their positions. Understanding the mechanics of the candle close allows a trader to distinguish between this temporary liquidity hunt and a genuine change in market structure. The first step is identifying a high-probability zone where institutions have previously shown interest. We look for price retracing into an established area of demand. This zone is the 20-minute higher timeframe bullish order block. It marks the price range where a significant volume of institutional buying previously occurred. We focus on two specific boundaries within this block. The first is the lower edge, which represents the point where the original institutional move began. The second is the 50% equilibrium midline, which marks the average price of the entire order block. Large participants often defend the average price of their position to maintain a favorable cost basis. If price stays above this midline, it indicates the original demand remains intact. If it closes below, it suggests that the sell-side pressure has exhausted the available institutional bids within that zone. By monitoring the 5-minute price action at these two boundaries, we can identify how the market is resolving the interaction between supply and demand. On the 5-minute chart, we watch for the reaction as price reaches the higher timeframe block. In a liquidity sweep, the candle probes below the midline or the block's edge. However, the selling is met with immediate limit buy orders that absorb the volume. This leaves a long lower wick. This wick represents the space where retail stops were triggered and then immediately offset by larger buy orders. The diagnostic confirmation is the close. To validate the sweep, the 5-minute candle body must close back above the 50% equilibrium midline. This signifies a swing failure pattern. The market attempted to move lower, found liquidity, and rejected the lower prices. The close shows that the buyers have maintained control over the average price of the block despite the temporary dip. This rejection provides the technical basis for a long entry. A limit order is placed at the 50%. A structural breakdown is characterized by a full-bodied 5-minute candle that closes completely below the higher timeframe block. The absence of a long wick indicates that there were not enough buy orders at this level to stop the price expansion. This is a breaker block flip. The zone of demand has been overrun and is now a zone of supply. Institutional participants who were long are now out of their positions or trapped, meaning they will likely sell any rallies back into this zone to minimize losses. At this point, the long bias is invalidated. Attempting to buy the dip into a broken block often leads to further losses as the market finds a new equilibrium lower. We now wait for a retest of the underside. The previous 50. A short position is executed if price touches the underside of the midline and shows signs of rejection, such as a bearish momentum arrow. This approach allows a trader to align with the new direction of institutional flow rather than fighting a failed level. These two scenarios form a protocol for interpreting price action as it interacts with institutional zones. This side-by-side comparison shows the visual difference between a reclaim and a breakdown. The liquidity sweep on the left shows price rejecting lower levels immediately. The breaker flip on the right shows price accepting those lower levels through a full-bodied candle close. The location of the 5-minute close relative to the 50% midline is the primary indicator of whether demand is holding or has been exhausted. If the candle reclaims the midline, the trade remains long. If it closes through the bottom boundary, the bias flips to short on the retest. This logic is visible in every interaction at the edges of an order block. The wick reveals where liquidity was found, while the close reveals where the market accepted value. By following these 5-minute diagnostic rules, a trader avoids becoming liquidity for institutional moves and trades in line with the established order flow.